Okay, while you get settled, we'll tell you briefly who we are so we can say hello. And in real life, I'm Bill Alexander. I work for Skadden Arps in Washington, and I mostly do transactional work. In this exercise, I'm going to pretend to be the senior partner in your firm.
And in real life, my name is Giovanni Alberto-Tanza. I'm a partner at Rosenberg, Martin, Greenberg in Baltimore. I primarily practice in tax controversy and tax litigation. For purposes of this exercise, I will be the junior partner.
My name is Chuck Hodges. I'm a partner with Jones Day in the tax department, and I'm going to be Gus.
I'm Bob McKenzie. I'm a tax litigator with the firm of Saul, Ewing, Arnstein, and Laird out of Chicago. And I will be Mr. Goodman, Saul, for this exercise. So you'll have two clients, two members of your firm.
Good afternoon. As I said before, I'm Joshua. This is my co-counsel, Jennifer. And we're here to talk about the Chicken Brothers and assorted transactions with other entities. So why don't we go ahead and jump right to it. We have provided slides to aid in this presentation. You can turn to slide 1. I'll go ahead and talk about the tax consequences of the formation of the TCB partnership. So TCB was formed in 2013, and by TCB I mean the Chicken Brothers. Saul, I believe, contributed $750,000 cash. Walt, who is not here, contributed kitchen equipment with a fair market value of $750,000 and a basis in that property of $900,000. When Saul contributed his $750,000, he took partnership interests with an outside basis of $750,000. Walt has a basis in his partnership interests of $900,000, but the partnership itself has an inside basis in the property of $750,000 because of provision of subchapter K in the tax code, which was enacted 9 years prior to the formation of this partnership. Jennifer is going to talk about the consequences of the sale of Lot A.
So TCB decided to sell Lot A, which was contributed by Gus, as we mentioned. There is a tax gain, which is $270,000, which represents the difference between the sale price, which is $510,000, and the inside basis in the property, which is $240,000. There is also a book gain of $60,000, which represents the difference between the sale price and the fair market value at the time of contribution. So the $60,000 book gain will be allocated equally to the partners in the amount of $20,000 each. The tax gain, on the other hand, will be allocated according to the traditional method that is specified in the partnership agreement, and it's designed to prevent shifting of gains and losses among the partners. The traditional method will first allocate $20,000 to each of the non-contributing partners, so Saul and Walt, and then the rest will be allocated to Gus. So $230,000 of gain will be allocated to Gus and $20,000 to each of the non-contributing partners.
No, wait, I'm not a tax person. So can you tell me, just in kind of simple terms, like, why do I have all that?
That's because you contributed the property and the property had built-in gain.
Okay.
So when the traditional method is designed to make sense. So Walt and Saul did not contribute the property, so they wouldn't have to claim that gain.
Can we maybe not use traditional and go more modern then?
Well, there are two different methods of accounting that we could possibly use, but the traditional method is the one that the partnership agreement follows.
Okay. Yeah, I have a question. What if he didn't report it? This occurred in 2014. What's the consequences of that?
We don't know if I reported this gain you're talking about.
We can do some further analysis and get back to you on that question.
Thank you.
Another issue that might come up if SJI goes through with this transaction is the branch profits tax. Because SJI is a foreign corporation, but doing business that is effectively connected with U.S. business, so selling the U.S. interests, then that would come under the branch profits tax, which is a 30% tax.
And who is that imposed upon?
That would
SGI?
be imposed upon SJI, yes. There is some relief for that because there is a treaty between the United States and Ireland which sets a lower rate. That is 5% of the gross dividend. So the amount that SJI is receiving from the sale is treated as if it was a U.S. branch of the foreign company and transferring dividends back to the parent, the foreign parent. In this case, obviously, you know, that's not what is really happening, but that is how it would be treated. Do you have any other questions for us?
Thank you.
Thank you.
Thank you.
We will ask you to come back in a few minutes and give you a brief critique of your presentation. We're going to consult among ourselves now.
Okay.